Welcome back to RateScope. If you've looked at gold and silver today, you're probably feeling a bit of whiplash. We just watched silver drop close to 30% in a single session, and gold isn't far behind. A week ago, people were calling this a new supercycle. Today, the same people are asking if the bull market is dead. The main story isn't some mysterious seller in the shadows. The real driver is much more boring on the surface and much more brutal in its impact. The CME Group, the exchange that runs the major gold and silver futures markets, has just hiked margins for the third time in a month. Margin hikes sounds like dry, technical jargon, but it's actually one of the key reasons prices are collapsing in real time. When you understand how margin works, you understand why we're seeing vertical candles, forced liquidations, and people getting blown out of positions even when the long-term fundamentals haven't changed. In this video, I'm going to walk you through how these margin hikes are forcing people to sell whether they want to or not, why the new Fed chair nominee, Kevin Warsh, is making markets nervous, what history says about crashes like this in gold and silver, and finally, what I would be thinking about if I were a long-term stacker versus a leveraged trader right now. By the end, you'll understand whether this looks more like the end of a bull market or a huge reset inside one. Let's start with what actually happened. Just days ago, gold was printing fresh all-time highs, and silver was pushing up toward $120 an ounce. Sentiment was euphoric. Social feeds were full of people calling this the real move, the supercycle, the this time is different moment. We'd had months of almost straight-up price action. That's exactly when markets love to flip the script. Two catalysts hit at almost the same time. First, Donald Trump nominated Kevin Warsh as the next Fed chair. Warsh is perceived as a lot more hawkish than the previous leadership. Markets quickly started to price in higher interest rate expectations, a stronger US dollar, and less tolerance for runaway inflation. In simple terms, if the Fed is more serious about fighting inflation, future money is worth more, and hard assets get repriced in dollar terms. Historically, when the dollar index rips higher in a short period of time, gold and silver usually get hit. Not because the metal suddenly became useless, but because dollar-based investors can get a similar safety feeling just by holding cash or treasuries. And global buyers see gold and silver priced in a more expensive currency. So the Warsh nomination was the first punch. The second punch was positioning. The market had become extremely crowded on the long side, especially in silver. We saw retail piling in, funds chasing performance. Overseas money, particularly from Asia, layering on leverage, price action turned parabolic. Each dip was bought more aggressively than the last one, and rallies were getting steeper and shorter. That's textbook late-stage behavior. As the old line goes, what goes up like a rocket usually comes down like a rock. This isn't just a cute phrase, it's how leverage works. Now let's talk margin. This is the part most headlines skip, but it's absolutely crucial. On futures exchanges like CME, traders don't usually buy $100,000 worth of silver by wiring in $100,000 of cash. They use leverage. Imagine a single silver futures contract controls 5,000 ounces. At $80 an ounce, that's a notional value of $400,000. Most traders don't put up $400,000. The exchange might require, for example, $40,000 in initial margin per contract. That's a 10-to-1 leverage ratio. Every $1 move in silver is a $5,000 swing in P&L for that contract. Leverage is fantastic when prices drift gently higher. Your returns look huge on a relatively small amount of capital, but it's absolutely brutal when the market reverses hard. Now, what does the CME do when volatility goes crazy? They worry about counterparty risk. If silver moves $10 or $20 in a day and traders don't have enough cash, the clearinghouse could be left holding the bag. So CME says, conditions are too wild. Starting tonight, the initial margin is no longer $40,000. It's $60,000. And maintenance margin goes up too. That's a 50% jump in required capital. If you're a trader with one contract and you only have, say, $42,000 in your account, you're suddenly under-margined. You have two choices, and you have to act immediately. Wire in more cash, now, not next week. Or liquidate part or all of your position to meet the new requirement. Most participants can't or won't wire fresh capital at short notice, especially when they're already taking losses. So they sell. The system sells for them. Their broker flattens positions. That's how you get a cascade. Margin is hiked, traders forced to sell. price drops even more. That drop triggers more margin calls for people who were just barely okay a day earlier. They sell, which pushes the price further down, and the spiral continues. None of this has anything to do with mine supply, solar demand, or central bank buying in the short term. It's plumbing. It's mechanical. And we've had 3 margin hikes in a month. Each one is like turning the leverage dial down another notch. If you were riding 10-to-1 and you don't adjust, you get carried out. So is this healthy, or is it a disaster? Here's where the experts split. On one side, you have big institutions like JP Morgan and PIMCO calling this a healthy washout. Their story goes like this. The market was too hot. Everyone was leaning the same way. Margin hikes are blunt, but they clear out the weakest hands. Once that's done, fundamentals can reassert themselves. And the fundamentals they look at are things like central banks still accumulating gold, structural demand for silver in solar, EVs, electronics, AI, and grid infrastructure, lack of meaningful new mine supply in the pipeline. From that lens, a 30% flush on leverage doesn't destroy the thesis, it resets the starting point. On the other side, the bears are saying, the era of zero rates and QE is behind us. A stronger dollar plus hawkish Fed means less fuel for speculative moves in metals. If key support areas break, you can get multi-month or even multi-year sideways consolidation. They're watching levels like gold around $4,400 as a big line in the sand, silver in the $60 to $70 zone. If those levels don't hold on weekly closes, they argue we're shifting into a different regime. The truth is, both sides can be partially right at different time frames. Short term, this very much is a leverage flush, not a new mine discovery. Medium term, if the Fed stays tighter for longer, the easy upside might be gone. Long term, the physical story for silver and gold still looks strong, especially as more countries move away from pure dollar reserves. Now, let's talk about you, because that's what actually matters. If you're a long-term stacker, someone buying physical silver and gold with no leverage, these moves are emotionally tough but structurally familiar. Go back through history. 1970s, multiple 30 to 50% pullbacks inside a monster bull market. 2008, gold drops hard during the financial crisis before ripping to new highs. 2011, silver explodes to nearly $50, then crashes, then grinds lower for years. Yet the people who added gradually at lower prices are the ones positioned when the next cycle comes. In almost every case, forced liquidations mark major buying zones, not tops, for people with cash, patience, and no leverage. If you're a trader on margin, the story is totally different. Crashes like this are where accounts go to die. Even if your long-term thesis is correct, if you get margin called at the wrong moment, you're out of the game before the market ever proves you right. So for traders, keep your position sizes small enough that a multi-sigma move doesn't wipe you out. Assume CME can announce another margin hike at any time while volatility is high. Know your invalidation levels before you put on the trade, not after. For stackers, crashes like this are a chance to review your average cost. If you've been buying only at highs, consider layering buys over time rather than all at once. Pay attention to physical premiums versus paper price. They tell you whether retail and wholesales are actually stepping away or using the dip. There are a few dates and signals I'd watch very closely from here. First, February 9th, when the CME launches a new 100-ounce silver contract. In theory, a new contract could provide more tailored exposure for certain players, improve liquidity, tighten spreads. In practice, it could also attract a fresh wave of speculative capital and algorithms. How open interest and volume behave around that launch will tell us if this is bringing in stabilizing hedgers or more hot money. Second, keep an eye on open interest in gold and silver futures, margin change announcements from CME, physical market indicators, Comex inventories, LBMA flow data, Shanghai premiums, and dealer inventory reports. If we see open interest staying low, inventories falling, physical premiums rising, even as paper price chops sideways or lower, that's a classic sign that the physical market is tightening while paper is shaken out. That's often how bottoms are built. Third, watch China and Asian flows. A lot of the aggressive positioning both up and down has been coming from overseas money reacting to US policy signals. When that hot money pulls back or flips direction, volatility in New York tends to follow. So what's the bottom line? The market isn't broken, it's resetting. The CME margin hikes are a kind of safety valve. They don't feel safe if you're in the blast zone right now, but they're part of how a leveraged system prevents even bigger structural damage. These events flush out too much leverage, force players to de-risk, let prices reconnect with fundamentals rather than pure momentum. If you're a long-term investor, crashes like this are usually the time to reevaluate your thesis. Check if the fundamentals have actually changed. They haven't much in 1 week. Decide where, not whether, you want more exposure. If you're a trader on margin, this is a time to survive, reduce risk, live to trade when conditions are cleaner. I want to hear from you. Are you buying this dip in silver and gold? Are you waiting for more blood in the $50 to $60 range? Or are you out entirely until the Fed and CME stop moving the goalposts? Drop your thoughts in the comments and let's compare notes as a community. If this breakdown helped you understand what's really going on behind today's crash, do me a favor. Hit that like button so more people can see it. Subscribe to RateScope if you want ongoing data-driven coverage of gold, silver, Fed policy, and global macro. Turn on notifications so you don't miss the next update when the CME or the Fed moves again. Thanks for watching, stay sharp, and remember, invest with logic, not hype.